Marcus was 31, working in tech and finally hitting his stride financially. He had $180,000 spread between two accounts at the same bank: his life savings, his emergency fund, his down payment. Then, in March 2023, he watched Silicon Valley Bank collapse on the news, and he had one terrifying thought: is my money actually safe? Today, we're going to answer that question with data, with real rules, and with a clear plan so you never have to wonder the same thing.
The FDIC, Federal Deposit Insurance Corporation, was created in 1933, right after the Great Depression caused thousands of banks to collapse and wipe out people's life savings overnight. Congress created the FDIC to make sure that never happened again. Here's the key thing to understand. FDIC insurance is automatic. If your bank is FDIC-insured, and most U.S. banks are, your eligible deposits are protected up to the coverage limits. You don't apply for it, you don't pay for it. It just works. Marcus didn't know this. Most people don't.
FDIC insurance covers the deposit accounts you hold at a bank. That means your checking account, your savings account, money market deposit accounts, and CDs, certificates of deposit. What it does not cover is equally important: stocks, bonds, mutual funds, annuities, and crypto. None of those are covered, even if you bought them through your bank's brokerage arm. Marcus had his savings and a CD at the same bank, so both were eligible for coverage. But here's where it got complicated, and this is where most people get tripped up.
$250,000. That's the standard FDIC coverage limit per depositor, per insured bank, per ownership category. So if you have $250,000 or less in eligible deposits at one bank under one ownership category, you're fully protected. Marcus had $180,000 total, so you'd think he was fine, right? Not exactly, because all of it was at the same bank, under the same individual account ownership. So technically he was covered, but only because he hadn't crossed that $250,000 threshold. Yet.
This is the part that most people miss, and it's where Marcus had a major light bulb moment. The FDIC doesn't just cover you once per bank. It covers you once per ownership category at each bank. An individual account, a joint account with your spouse, and an IRA are all separate categories. That means a married couple could have $250,000 in individual accounts each, plus $500,000 in a joint account, and $250,000 each in IRAs, all at the same bank, and all of it could be fully covered. That's potentially over $1.5 million protected at a single institution when you structure it correctly.
Let's look at the actual history of bank failures in the U.S., because this isn't a new phenomenon. During the 2008 financial crisis, we saw 25 banks fail in 2008 alone, followed by 140 in 2009 and 157 in 2010. These were real institutions with real depositors. Then things calmed down through the 2010s, fewer than 10 failures per year from 2015 onward. But 2023 reminded us it can happen again. Silicon Valley Bank, Signature Bank, First Republic, 3 of the largest bank failures in U.S. history in a single year. This chart is exactly why Marcus started paying attention to FDIC limits.
Here's something that surprises most people. When an FDIC-insured bank fails, you typically get your insured money back within just 1 to 2 business days. The FDIC has paid out on every single insured deposit since 1933, a 90-plus-year track record. No insured depositor has ever lost a single cent of FDIC-insured funds. Not in 2008, not in 2023. The question isn't whether you'll get paid, it's whether your deposits are actually under the coverage limits. For Marcus, that realization shifted everything. He wasn't panicking anymore. He was planning.
Let's talk about what actually happened in March 2023. Silicon Valley Bank had $209 billion in assets and was the 16th largest bank in the U.S. When it failed, the majority of its deposits were from tech startups and venture-backed companies, and most were well above the $250,000 FDIC limit. Businesses had payroll sitting in those accounts. This is where it got serious. The FDIC and Treasury made an extraordinary decision to protect all depositors, insured and uninsured, to prevent a broader financial panic.
But that's not always guaranteed. The lesson? Don't rely on extraordinary government action. Know your limits and structure your accounts accordingly.
So what did Marcus actually do after all this? He took 3 practical steps. First, he worked with his bank to split his savings into an individual account and a joint account with his partner, instantly doubling his coverage at the same institution. Second, he moved a portion of his emergency fund to a second FDIC-insured bank, which added another $250,000 in coverage. Third, he used the FDIC's free online tool called EDI, the Electronic Deposit Insurance Estimator, at FDIC.gov to verify exactly how much of his money was protected. This is for educational purposes only, and I'd encourage you to check EDI for your own situation before assuming you're covered.
Here's the most powerful number in this entire video. Since 1933, through the Great Depression aftermath, through the savings and loan crisis, through 2008, through 2023, insured depositors have lost exactly $0. Not a single cent of FDIC-insured money has ever been wiped out. That's over 90 years of protection. The system works when your deposits are structured correctly within the limits. Marcus came into this research scared. He left it empowered. And that's exactly the difference between financial anxiety and financial literacy.
Marcus went from panicked to protected in one weekend. He restructured his accounts, used the EDI tool, and confirmed that every dollar of his $180,000 was covered. He didn't need a financial advisor for this. He just needed the right information. Here's your action plan. 1. Confirm your bank is FDIC-insured at FDIC.gov. 2. Know the $250,000 limit per ownership category per bank. 3. If you have more than $250,000 in deposits, use joint accounts, IRAs, and multiple banks to increase your coverage. And 4. Check EDI. It's free, it's fast, and it could save you from a very painful surprise. Like, subscribe, and share this with someone who needs to hear it.
Everything in this video is for educational purposes only and does not constitute financial or legal advice. FDIC rules and coverage limits may change. Always verify current information directly at FDIC.gov. Please consult a licensed financial professional for advice specific to your